A company raising a £500,000 pre-seed round is completely different from a company raising a £10 million Series A funding round. The risks are different, the expectations are different, and the level of evidence will be completely different too. One mistake I see newer angel investors make all the time is treating startups as if they are all being evaluated the same way. They are not the same. I think if you don't understand what stage a company is actually at, it becomes very difficult to judge what good looks like, what risks are normal, and what signals actually matter inside that business. Hi, I'm Rupert Poppet, the founder and managing partner of Araya Ventures and House of Araya. In this video, I want to break down what pre-seed, seed, Series A, and bridge rounds actually mean, what I personally look for at each of those stages, and how I think about risk, traction, and founder quality as an investor. The biggest thing to understand is that fundraising rounds are milestones in risk reduction, and that's all they are. At each stage, the company is trying to prove something new, that the problem exists, that the customer wants the product, that the business can still scale, and the economics of that work. Different investors care about different things depending on where the company is in that journey. This is part of a series I'm building for UK investors who want to do this properly, and each video covers a different piece of the process. Make sure you subscribe so you get each one as it comes out. Pre-seed is the earliest stage of funding. Some of my best performing investments as an angel investor came from pre-seed companies that were pre-product and pre-revenue. Often, the company doesn't have a product yet, doesn't have revenue as I mentioned, and sometimes it's even pre-team beyond the founders. It might just be an idea, a strong insight, or one or two founders trying to build something important. So at this stage, you're essentially heavily investing in the people. I care far more at this stage about the founders, the market insight, and the speed of learning at this stage. So the speed of learning between the founders, between the commercial team, the product team, and how that feedback loop is working. At pre-seed, I'm looking at how big is the pain point, who is feeling that pain point, and how much do I believe that that solution is the right solution to solve that pain point in a meaningful way. I'm also thinking how scalable that solution is. I also spend a lot of time thinking about founder market fit. Why these founders? What gives them an edge in understanding this market? The strongest founders usually have some kind of unfair insight. They've lived the problem, they understand the customer deeply, and they see a shift happening before most other people do. And especially now with AI, we're seeing a new generation of companies being built fundamentally differently, emphasizing on smaller teams, faster execution, and global products from day one. We've already seen billion-dollar companies being created with one employee in the market. And that really changes how you're looking when you're looking at evaluating a pre-seed company. At this stage, the signal is unlikely to be revenue. It's unlikely to be strong user engagement, but we hope it could be. We're expecting to see rapid product iteration, customers pulling the product out of the founders, or unusually fast technical execution. You're looking for signs, essentially, that something real is happening underneath the surface, and I often call this momentum metrics. What can the founders show me that illustrate the momentum that is currently being created even when there is no revenue? Seed stage is where the company starts becoming operationally real. The question now becomes, has this company actually become a business? At this stage, I expect to see stronger evidence around product market fit, customer behavior, retention, and how the company learns as it scales. Typically by seed, there's a product in market, there's customers, hopefully some revenue, and the founders have a clearer understanding of who their core customer is. One thing I really like to see with founders who start with a very specific customer segment and dominate that first before trying to become everything to everyone. That's usually a much smarter way to build. A lot of companies can generate excitement initially, but far fewer can get customers to keep coming back. And that's why retention matters so much, as it tells you whether the product is genuinely solving a problem or whether momentum is being created through spend or hype. One of the things I've seen recently in some of our seed stage companies is really how powerful it is to see this specific ICP customer, to see the retention figures of those customers and the minimum churn that those customers are doing. So really understanding at the forefront of how those customers are behaving with the product, how seriously they're taking the product and their workflow as well. Bridge rounds are also interesting because I think they're often misunderstood. Definitely when I started investing as an angel, I thought bridge rounds always meant that like things aren't going well. But a bridge round can be a good thing as well. Bridge rounds typically happen between pre-seed and seed, or between seed and Series A. I used to, as I mentioned, think of them as a negative sign that the founders had maybe run out of money and they're coming back for more before the next round. But bridge, as I mentioned, can be a lot of good things and different things as well. For sure, sometimes it's poor planning. Sometimes founders underestimate how much cash they need to hit those milestones for the next round. But sometimes it can actually be a positive signal as well. Like maybe growth accelerated faster than they expected and they need some more capital to fund that growth. Maybe there's an acquisition opportunity. Maybe they found stronger product market fit and want more time before repricing the business in the next round. Or maybe they're very close to a major institutional round and you can enter just before that happens through the bridge. That can create genuinely interesting opportunities for angel investors. Occasionally, you can invest at a discount just before a significant value inflection point. The key with bridge rounds is context. You need to understand why the company needs the capital, what milestones it's trying to reach, and whether this is strategic or whether it's reactive. Those are all very different situations. As an angel investor, you'll typically enter a round at a pre-seed, a seed, or a bridge round. At Araya, our funds also invest in pre-seed, seed, and sometimes bridge rounds. We only invest in Series A rounds if we are following on in a future funding round of a company that we've already backed previously. By Series A, expectations become much higher. This is because investors want evidence of repeatability, not just potential. At this stage, I'm looking much more deeply at revenue quality, growth consistency, unit economics, scalability, and operational maturity. The company should have a much clearer understanding of who the customer is, how they acquire them, and how the business grows efficiently. And this is usually the stage where companies transition from the founder-led chaos of the early days into actual systems and scalable infrastructure. And this is where many companies take a leap, because what gets you from 0 to 1 is very different from what gets you from 1 to 10. For me, early stage investing is ultimately about identifying exceptional founders before the rest of the market fully sees it. The best companies rarely look obvious at the beginning. If they did, everybody would invest. So a huge part of angel investing is learning how to recognize real underlying strength while there's still uncertainty around the business. Actual signals, not just noise. Last year, we backed a company called ResearchGrid. I met Dr. Amber Hill, the founder of the company, in 2024. ResearchGrid is transforming clinical trials through AI-driven automation and patient recruitment. It is improving the speed and the efficiency of clinical trials and drug development. When you first do desktop research, when you get an investment opportunity like this, at first, the market may look crowded. There is a lot of M&A, there's a lot of consolidation in the space, and a lot of large players who were adding AI layers on top of their businesses and to their websites. However, ResearchGrid had built real IP and value. The founder had really deep domain expertise and had experienced the problem firsthand. She was a researcher for over 14 years. She was building defensibility in a very unique way and had attracted tier 1 pharmaceutical companies as clients from the get-go, which made it really clear that this was a company worth backing. Now the company has just been valued at multiples by other investors of where it was, and we have just doubled down on our investment from the fund, and we've also opened it up to House of Araya members to invest alongside us. Understanding the difference between pre-seed and seed, bridge and Series A makes you a much stronger investor, as it changes the questions you ask, the risks you focus on, and the way you interpret traction and progress. Everything I cover on this channel, the investment patterns I'm watching, the thinking behind how I invest, and what our fund is actually seeing in deal flow, I distill into a 5-minute newsletter every Tuesday morning. It's called Araya Signal. It is one insight, there is no filler, and is completely free. The link is in the description below and it's pinned in the comments. If you're serious about investing better, it's worth 5 minutes of your Tuesday. Subscribe.